Well, despite Dell big deal today, our next guest does not expect a big surge in M&A activity over the next 12 months. Fred Lane is the vice chairman of investment banking at Raymond James. He previously was the co-head of DLJ's M&A department. He joins us now from our Boston newsroom. Sir, welcome to Bloomberg News.
Thank you, Mark.
You don't see the big surge coming. Why not?
Well, it's all relative. I mean, it depends on how big a surge we're talking about. I think all M&A bankers, being optimists, look at a few snow flurries and say, gee, it's going to be a great powder day tomorrow, and it doesn't quite work that way. I think there's too much murkiness in the economy, despite all the cash on the balance sheets and the strengthening of corporate balance sheets in general, to think we're going to see a tremendous upsurge in M&A volume. We're certainly going to see upsurges relative to what we saw in the last calendar quarter of 2008 and the first calendar quarter of 2009, when we saw no activity, and we didn't see a very strong second quarter either. So we're going to see a resurgence, but I don't think we're going to see the kind of activity that creates the headlines we might like to see, or that make for the really great stories. But we're getting there. It's an improving situation, but again, it's all relative.
Was that because the last big surge was due mostly to declining interest rates?
I believe that to be absolutely the case. During 2003 to 2006 or 7, if you ran a private equity firm and you used leverage, you could buy a company at 6 or 7 times or 8 times EBITDA, and 2 years later you could get a lot of your investment back, or all your investment back, by adding 2 or 3 turns of EBITDA to the balance sheet. And that's exactly what we saw. Basically, debt was being poorly allocated. The risk of debt was being poorly calculated. And, of course, we had the undoing in the debt markets that frequently follow such a bubble.
Fred, I also want to ask you about purchase prices right now. We were just talking about Dell and Perot. Some analysts are saying that Dell's paying too much for Perot. Are valuations going to be another obstacle here to more deals getting done?
I don't think so. I think when you see a Dell pay a 68% premium to Perot Systems market cap, and you see the kind of very substantial multiple that Disney paid for Marvel, you can be sure that strategy is driving these transactions. Both revenue synergies, i.e. the buyer thinks he can drive sales to a much higher level, and also cost synergies where there are efficiencies and overhead costs that can be taken out of the combined entity. So I think we're going to continue to see strategic deals, actually, where there's a fairly substantial premium being paid.
Right.
But again, I think it's very hard to look at the outside, from the outside, and say, gee, they paid 25 times earnings. That's uneconomic. Frequently, to the buyer, it might be half that.
Are we seeing, Fred, a lot of companies increase their savings rates? Are they taking their cues from the consumers?
I believe so. I actually think corporate behavior and the average American household are behaving similarly. I think there's a lot of cultural norms that drive all of our behaviors, including personal consumption. And obviously, the average American household has cut consumption, has cut debt, has increased savings rates. There's been a lot of deferral of putting that deck or that swimming pool in. And likewise, at the corporate level, I think there's been a lot of deferral of capital expenditures.
Right.
Where did all this liquidity come from? When demand dries up, inventory shrink, receivables shrink, and cash is produced, people repay debt. That's the corporate side of it. It's the same thing really is happening for those who happily have kept jobs. Unemployment is a sad situation, but if you've kept your job, most people are behaving in a much more prudent way, which is probably in the long run good for a long, steady expansion beginning, I believe, in the first quarter of 2010.
Fred, just quickly here, if these companies, like consumers, are holding on to more of their cash, they are savings, and it's not going to go towards a big surge in M&A, what is this cash going to be used for? Is it just going to be kind of held on to by these companies for right now?
Well, I think some of it's going to go back into inventory buildup. I think despite the great supply chain software we have out there, you still have to build inventory to sell product. That's the first point. The second thing is we are going to see expansion in certain industries, and we are going to see acquisitions. I don't want to suggest that we're not going to see acquisition activity. I think we are. I think sellers have capitulated, and as prices rise, buyers will step in.
And Fred, I'm sorry, we're going to have to leave it right there. Fred Lane of Raymond James joined